Hi guys, welcome to Investing with JYK. And yesterday I actually recorded the same video, and I did not. I muted myself, so I recorded 40 minutes of just me flipping through the pages. So again, today we'll talk about Ensco. Ensco is a offshore drilling company, and then it basically leases crew and drilling rigs to exploration production companies on the ocean, and so basically they drill for oil under the sea. And they have been under a lot of pressure. If you look at their PB, can see it is 0.36, so that is extremely cheap. Obviously they're losing money, so there's no PE to look at, but this extreme low PB typically means it's probably in a cyclical low. So this is a cyclical company, and as we discussed previously, you want to buy these things on the down cycle. You want to buy when they're really cheap. You especially want to buy them when the commodity they're producing is actually going up in price, but their price is still subdued. So this is Brent price. It's like $80-ish. It's gone up quite a bit recently, but here's the graph from 2000 to today. Note the shape of this price graph. Now if we look at the same thing for Ensco share price, you will notice that there's a drop in early 2000s, there's a drop in early 2000s, almost the same time. Then it all the way increased up to 2006-ish. Increase to 2006-ish, there's a slight drop, and then there's a peak, 2008, peak, 2008, massive drop, 2009, right? And then a increase and a slow down, and an increase and kind of a slowdown here, and a massive increase again in 2011. Massive increase here, and there's up and downs on the top. So the price basically did not move much for 3 years. Price went up and down, more volatile, but basically did not really move much for 3 years. 2014, this is about the same time, massive drop, massive drop. 2016, early 2016, bottom of oil price. Early 2016, not really bottom of their share price. So we have this pretty nice thing which kind of just follows oil price all the way, but you can see the correlation breaks down here because oil was going up, and this stuff should go back to somewhere here, maybe $30 or whatever, right? Oil is now at the same price as 2010-ish, this peak. So we should be looking at this price, but no, it's here. So that is interesting. Does not mean this is going up, but it is interesting. Also, we have to dig a little bit deeper, but this is a good sign. We have something that basically follows the oil price, and now it doesn't. What happened? So let's think about the economics on offshore drilling. Offshore drilling is more expensive than on land drilling, obviously, because now you have to build these things that will withstand ocean instead of, you put them on land. The worst thing that will happen to them is a bit of rain and maybe wind. On the ocean is wave, and if you lose it, there's no one to save you. And if you want to have people manning that rig, these are going to be very highly paid jobs because they're extremely boring. You have nothing to do. You have no social life, basically. You deal with the same people for extended periods of time. You have to ship them to operate on it. Right? So everything becomes more expensive once you go to sea. And I found this report, this EIA report. Whoa. Trends in U.S. oil and natural gas upstream costs. And here, they started talking about deep water production costs. And what we can see is that they say, okay, typically you can get around $60 per barrel break even. And if you do a bunch of cuts, which may have long-term consequences, you can potentially get down to 40. So say, oil price, if it's below $60, essentially all of Ensco's asset, basically the rigs, are worthless because nobody wants to drill for a loss. So that basically means they are super leveraged to the oil price. Anything below 60 at the moment, at least, because the cost of drilling slightly increases until you get some kind of technological breakthrough. So maybe in 2000, because you can drill at shallower water, you can employ people at lower cost, but now everything's more expensive. 15 years later, everything's more expensive. Your cost of production is now 60. So they basically, if you imagine the line here, $60. Anything above, they make money. Anything below, nobody want their shit. Okay, so that's one thing. And the other thing is, if you look at this thing, IHS market, and this is April, so fairly recent data. You can see that these are different types of rigs. Utilization went down, so 60% of the stuff, the rigs are not currently contracted. Utilization down, utilization half. This is 60%. This is 40%. This one again is like 50%. So that's what we're looking at. And if you look at the daily rate, it's been going down forever. And my guess is that this will go back a bit again at some point. Same here for different regions, right? You got a slight uptick here, but again, very cheap. So Ensco is, as I said, is a typical cyclical company. Even though it does not directly produce oil, their prospect is entirely tied up to oil production and oil prices. And the other thing is that they have no pricing power because your rig, my rig, same thing. Unless you have especially well-trained crew that is super efficient or something. But that's just not very likely because these rigs are built so that they want to have a minimum amount of training as possible. Obviously, these people are relatively highly trained because it's harsh environment, low margin of error, and all that stuff. You don't want to die in the sea, basically. So that's one thing. And as we discussed in some of the previous videos, in a cyclical company, the correct way to operate is being counter-cyclical. And to be counter-cyclical, you need to be buying at the bottom of the cycle, and the top of the cycle you should conserve capital. Did Ensco do that? So that basically tells us the quality of the management, right? You can cut your cost, but in this case they can't really cut much because most of their cost is depreciation, so that really can't be cut unless they can buy the things cheaper, but they don't produce it. So that's it. The other one they can do is a better capital allocation. So don't buy at the top of the cycle, buy at the bottom of the cycle, preferably just before the whole thing turns. So let's see how they managed. So I saw this news, 2017, last year, they decided to buy Atwood Oceanics for $850 million in an all-stock deal. So the all-stock deal was effectively going to be $10 per share, but by the time the transaction closed, Atwood actually was at $9.72, so that should be very close to this price, to the price of sorry, Ensco, effective Ensco shares. So basically that means Ensco went down about 10% between this and the conclusion of the transaction. So what did Atwood have? So Atwood again is the same type of company. They just lease out their rigs. Right? So I found the last quarterly statement. So this is the last 10Q for Atwood Oceanics. And for a company like this, a cyclical company, all you really need to look at is their asset. What is their liability? What is their asset? Their asset is, in this case, just a bunch of rigs. This is the majority of their asset. And they have some cash, and they have some debt, and they have some long-term debt. So overall, Ensco was able to acquire $3.4 billion worth of shareholder equity for slightly less than $850. So that is very good. You want to do deals like this because the cheapest time to expand is at the bottom of the cycle. And then when you want to expand, you either can buy new rigs, in which case you won't get much of a discount because a rig is a rig, it costs that much steel, and these manufacturers won't be selling to you at a steep loss because why would they? They could just fire all the workers and let the manufacturing facility stay idle and wait it out, right? Because otherwise they lose more money because the variable cost of a rig is very high. Now, or you could acquire a competitor and they have the same type of asset as you, and it's completely interchangeable kind of asset. Right? So you buy a bunch of rigs, so $4 billion worth of rigs and some $600 million of current asset and a bit of debt, and you pay it with the thing you're paying is a debt, and you have to assume their debt, and you also have to pay them. So you pay them tiny bit, $850. So that's 25% of the shareholder equity. So there you're paying 25 cents for the dollar, and some of that is even extremely $1 for $1. So this is actual cash, so like actual dollar. And you have these rigs that you will need in the future to produce income, and you're paying tiny for that. So this is a very good deal. I very much like this. Right, so that's one thing. They are buying at the bottom of the cycle. The other thing is, are they conserving cash? Were they conserving cash at the top of the cycle? So we look at their consolidated balance sheet. Well, that's not long enough. Well, at least in 2016 they did have $3 billion of current asset, and their revenue back then was like $2 billion, I think. If you look at their revenue, yeah, there was like two point something billion dollars. So by that they had more liquid asset. So the current asset, they had more current asset than their yearly revenue. So I would say they were fairly, like, reasonably conservative. They did not, go all out with acquisitions and stuff at the top of cycle. So that's good. But they might have done something like that. I did not check all their history. Okay. So the next worry we have is this thing going bankrupt? So again, we need to look at their balance sheet. We need to look at the balance sheet, their cash flow, and then their debt burden, right? So those are the things we need to think about. So current asset, I'm assuming these are good. Right, so they have 1.6 billion. Their current liability is half that, so that's good. At least next year they're not going anywhere. And then if you look at their operating cash flow, in 2017 they were able to get $250 million. So they were making, as long as they don't invest, they will be milking their current asset for positive cash flow. So they have 1.6, and then they're making 250 a year, and they're still buying and selling stuff. So in this case, they bought some stuff, and then this one is the acquisition of Atwood. So this was very good deal, very good deal. And they spent some money. I'm assuming that they had to pay some debt off for Atwood. So Atwood had $1 billion in debt, right? So they had to pay their debts, and then they got their cash. So that kind of adds up. So let's just check. They had $1.3 billion in debt, and then total liabilities. Say we get rid of all that and then take out all the cash, so you're looking at something like 800 something million dollars. Yeah, so that's basically what they got. So they paid $800 million. Now they got Atwood basically completely debt free. Fantastic deal. For me, this is a fantastic deal. I don't know what this is. 500 million. I don't know what they bought. If I were them, I probably wouldn't buy those. I would buy more Atwoods, because for this amount of money net, they acquired $4 billion worth of rigs. Why would I, do these? Anyways, maybe they bought used or something, second hand. So they spent some money, and Financing, we don't really have to look at that. Basically, you know, they have some stupid cash dividend, which is 1 cent per quarter is token. I don't know why they're doing it, but they're doing it. So okay, so current situation, they can cut this to 0. This stuff, short-term investments, hopefully these are money good. So these doesn't have to be there. So this stuff, they have this to sell basically, right? So this can potentially turn, let's see, short-term investments. They don't have to buy this, is what I'm saying. They did reduce the total holding by $1 billion, right? But they don't have to. This is basically, let me think how we should think about this. Yeah, well, we don't really have to think about the effect of these two because that's essentially your short-term investments. And this is a one-time thing. This thing is, you can cut, so this can go to 0. So 250 income in terms of cash flow, and about 1.6 currently in present the current asset, so liquidable. So let's look at their debt summary. So they have this revolver which is going down and down and down and down in terms of limit, from $2 billion all the way to about $1.2 billion until 2022 when this thing matures. The rate is LIBOR or base rate. I'm not sure what that is. I'm guessing this is the Bank of England. Yeah, Bank of England, their rate, or LIBOR plus either 3 or 4%. So it's a floating rate. So if interest rate increases, they will suffer. And now let's look at their actual debt, not the revolving credit facility, but the actual debt. Actually, let me look at how much they owe. Let's see how much they have currently. Revolving credit facility. I'm seeking to improve the given as we have completed several transactions, have increased that we issued with new senior debt. Pro forma fully available. Oh, so they didn't spend anything. That's very good. They did not spend anything out of that $2 billion. So that is something they can be using. Very good. So in terms of liquidity until 2019, like September 2019, they would have another $2 billion. So assuming they get another 250 coming in, but in 2018, by 2019 they should have 500, close to 500 million extra. And imagine this situation does not improve, right? So $2.1 billion in new cash. Sorry, $500 million ish in new cash plus $2 billion in available liquidity from the revolver plus $1.6 billion in existing current asset. So you're looking at 1.6.2.5, $4 billion, say $4 billion, right? So stuff they have due in 2020, you got very little. 2021, very little. 2022, 23, nothing due. 24, a bunch. So until 2024, there's no way they will have any liquidity issues. They might still be losing money, but they won't go bankrupt for sure before 2024. is what I think, because all they need to pay back is less than $300 million. They can pay that out with their cash that they have on hand. In fact, they could even if they have no cash on hand, they can pay those off with 1 year of operating cash flow. Now they have these guys, so that's like close to $2 billion here on 2014. Sorry, 2024. So that's something. So can they pay? I assume they can. They could, if they can renew the debt, obviously they can pay. If they can't renew the debt, I think they still can pay based on their they still have the they still should have enough money, in a sense that if they continue to produce 250 in operating cash flow. So 250 times 2024, so that's 6 years plus 1.6. Sorry, 1600 minus $2 billion minus, this is what, 250. So they would still have 850 left in terms of liquid assets, even in 2024. And then if you project out 2025, you are looking at another 600, 669. But then you have to add the operating cash flow. So I'm assuming nothing changes. Right? So 431. So they will survive all the way to 2025 is my estimate. If nobody wants to lend them more money, first of all. Secondly, nothing improves. Right? So it's a fairly bearish look, and they should be able to survive. So that makes me comfortable that I have a fairly long runway for this company, and they won't go bankrupt anytime soon. And then this is always a real worry. And then the reason, one of the reason is that if you look at, by the way, this Clarkson plateau, they seem credible. I can't vouch for them, but I'm just taking their data on the face value. So this is an interesting graph, but we can look at this first. The reason Ensco has a real probability of going bankrupt is if you look at their debt. Their net interest-bearing debt over EBITDA is 6.3 times. That is very high. That means if you do not invest, if you have zero capex, because DA is essentially the DA needs to be replaced by capital expenditure. Once you do capital expenditure, you now have depreciation in the future, right? So if you never do replacement capital expenditure, your DA will eat you entirely. But what this is saying that if they do not invest at all for 6 years and they make no actual income, so they don't get taxed, and interest is basically we're talking about debt itself. So interest can in a way be removed. So EBITDA is you take away the effect of capital structure and you take away the effect of capital expenditure. I can be removed by essentially issuing shares. So this is saying like how much underlying earning power does this company have compared to its debt? It's a commonly used ratio to determine the strength of the balance sheet. A 6.3 is fairly bad. Under 4, okay. If you're on like 2 or 3, typically you don't have to worry too much. So in this case, row 1 and Transocean are, you know, has less debt than Ensco. So that's why I was looking at, you know, how far can this company survive if things go to shit. And the other interesting graph is this. CapEx on offshore drilling, well, for specific type floater. Not uninteresting until oil price went through the roof and you got a huge build, and the whole thing just collapsed in 2016. I see no reason it would pick back up in 2017 or 18 or anything. The reason being this: the utilization, you know, the floaters. Do we have a floater here? Jackups. Well, probably similar. So the utilization is 50% on the industry. Why the hell would I build anything more when the whole industry is 50% utilized? No reason, right? So that's why I foresee. Wait, where is that? Here. Why I foresee this very low capex to continue. Now, why? So, if nobody spends money, all these stuff will start to age. Once they age, at some point you have to retire them. So another important thing is how, well, two things. How many rigs that Ensco owns currently are contracted out, that are currently earning them income, and how many are, you know, in like some kind of mothballed state. And the other thing is how old are these rigs, right? So Ensco has a list of their ships. Actually, not ships, rigs. So let's look at these. They got some fairly new stuff. And these are all fairly new. They got one old one here. I mean, let's say anything older than 10 years old, right? So you got one old one, one old floater. And these numbers, basically, this is a rebuild. So the first time it's built in 1982, and it's rebuilt in 2014. I'm assuming once you rebuild it, it's actually going to be useful for, you know, as good as new, almost. It's my assumption. And if you look at jackups, you got old, 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 old. So let's count them. Count this whole thing. We got, so we don't forget, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So there are 21 ships that are more than 10 years old. And let's look at their status. So they have, so there are two states actually. There's preservation stacked, which is Ensco's lingo. Typically people call them warm stacked. That just means they're maintained. You got a couple guys on the ship, on the rig, to maintain them so they don't rust and they don't like go die. You got under contract, so that's earning money. You've got available, that's not earning money and sitting around. Actually, there's a fourth state, which is cold stacked, which is basically, it's like sent into graveyard and put there, and if the situation gets much better, and then you can use them. It's you know, imagine the aircraft boneyard in US. You put the aircraft there, it's not protected, it's subject to the elements. The aircraft probably doesn't rust, but these drill ships will definitely rust, and nobody's on them, and you know, so very slow to bring back up, and also very expensive to turn on again, because you have to do extensive checks and maintenance and renovation on this. So let's see what they have. Actually, let's put them into a into Excel if possible. Oh, why can't this just use Shift like everything else? Excel. Oh, that doesn't work. Never mind. But let's try to just eyeball it. Got under contract bunch. Maybe a third is preservation stat plus available, and then very few that's cold. You have one that's cold stacked, and if you notice, this is the oldest one. So yeah, and if you go to jackups, bunch under contract, a lot of them under contract, in fact. And then you have a very few that's available. You got 2, 3. You got 3 that's available. 1 they're building. I have no idea whether they're building anything, but they're building. Bad. And if you look at all the old stuff, cold stacked. A bunch of them are cold stacked. I don't know why they're cold stacking 2012 rigs, but okay. And then cold stack 2003, yeah, that makes sense, right? Very old stuff, you want to cold stack them. 1996, why it's not cold stack? Because it's under contract. If it's earning money, I'd just leave it, keep earning money. So the status of their fleet is basically most of their stuff is under contract, probably 2/3, I would say. And then 1/3, within the rest of the 1/3, I'm saying maybe, let's say, you know, 40% of that is 30% is on a cold stacked, and then the rest is either available or preservation stacked. That's their status. And then the good thing, and then they have some under construction, which is extremely weird. Why are you buying them? But I don't know. But like 3 that's under construction. Makes no sense. Anyways, so that's their ships. So that's doesn't look too bad, but also doesn't look too much better than industry. 2/3 is 60%, so that's about the same as these. If you say, you know, 50-60% utilized, that's what Ensco has. So not doing any better or worse. So I started buying at around here, and I kept on buying all the way down to here, and then I stopped. And recently has picked up a bit, but yeah. So the thing that will turn this around is if oil keeps going up, if we get a little bit of oil shortage, and then what happens is people will rush out to try to explore or start producing either on land or in the sea. And now utilization will go back up, the daily rate will go back up, and Ensco's asset, their rigs, will then start being valued at least 1 PV, you know, at their actual depreciated value. So yeah, so that's what I have in mind for Ensco. I think before they run out of cash, which is as I projected as something like 2026, their asset will be valued at 3 times as they are being valued now. And yes. Oh yeah, one last thing is if you look at their balance sheet again, right, if you look at this again, property and equipment at cost, this is how much they paid for their rigs. So they paid total $15 billion, and their accumulation is something, the depreciation, accumulated depreciation is how much they think these things have depreciated, and this is what they think is the fair value now. So obviously, one thing you have to worry is that are they overstating the residual value, or are they understating the depreciation? So you could look at their divestitures. So basically, that's when they sell their ships, right? So they could say my ship's worth $10 billion, and if people only pay $1 billion, then it's not really, nobody cares what you think. So we want to see if they're on this, if their estimate is actually correct. So I found this thing for that. The following rigs were sold in a 3-year period, and you can see that in total they got 22 million out of it. They assumed the rig itself is worth net $14 million. So they actually earned it. So they had slightly underestimated the net book value of these rigs. And why is net book value? Because they have liens on these things. They some of the debts are directly tied to this asset. So yeah, they seem to be very conservative on the valuation of their rigs. So that's good. That means the asset is more likely to be understated than overstated. Okay, so to conclude, I think we have Ensco. It's a cyclical company, highly leveraged to oil price. Oil has gone up since 2016. Ensco hasn't. The reason is that there's a lot of rig supply, and they did the logical thing, the rational thing of buying Atwood at very cheap prices at the bottom of the cycle. And they have high debt. They seem to be able to sustain themselves to at least 2026 if they are careful with what they do, and hopefully they are. And I think by 2026, and by 2026, I think they would start making money, and their asset will be valued at least 1 PB, so a 3x return. And that is my thesis. Let me know if there's any problem, anything wrong with my analysis, and click like if you like this, share it with your friends if you think your friends like investing too, and click that dislike if you hate this. See you next time, and hopefully I have recorded all my voice.